What's going on, guys? Brian's here. Today is Friday, December 6th, 2024, and this is a follow-up to the calendar spreads video that I released earlier this week. This video right here, a step-by-step guide to trading calendar spreads. In this video, I used a live trade example of this 6,035 call calendar spread that I opened on Monday. So this is just a few days later. This is the risk profile on Option Strat, and this is the risk profile in Thinkorswim for those of you that use Thinkorswim or are familiar with a more advanced risk profile. The P&L right now, I'm up $634 or so, and it's fluctuating as the market is currently open. I'm in 4 lots of the spread, but to analyze and to explain to beginner traders, I like to use one lot and I like to use Option Strat as it is a little bit more beginner friendly to interpret what's going on. The spread costs $950 per lot. So with 4 of them, that means I use just under $4,000 to open the position. But again, with one lot, we can just say it's about $1,000. The trade is currently fluctuating between 12 or 15% or so. And as I explained in that previous video, I like to keep track of the implied volatility throughout the duration of the trade as well as the profits. So that's why I just wanted to hop on here today and show you guys a continuation of that video, as I showed the example of when I first open it, the type of notes I leave in the description when it hits that first target right here. It actually hit almost 9% a couple of days ago, which was Wednesday, which based on my experience is a great place to take profit. I'm continuing to hold the 4 lots because I'm not trading my full size, and I also have other positions around this main position. So I'm trying to stretch the P&L as much as possible, which is why I don't brand or label myself as an exclusive income-based trader. An exclusively income-based trader is going to follow a list of very strict specific rules, meaning they enter their trade, they hit their profit targets, they close the trade, they open up another set of calendars, and they just rinse and repeat, and they continue to go along. I will usually interject a little bit of discretion. I will usually trade around some of my income spreads as I use other tools that influence my discretion, like gamma exposure, some of the quant trading app levels. But for the most part, these trades are relatively systematic. This is Monday here, roughly Monday morning when the position was opened. And here we have on Friday where the SPX is. So even though the peak of the calendar spread was right around here, which is 60.35, we can see that the SPX is all the way almost at 6,100 and the spread is still profitable. Quant Trading app members, you guys will notice that the tents will generally line up with our weekly levels. That's something I like to do. At Quant Trading App's inception, these weekly levels were actually generated to help iron condor traders as well as calendar spreads swing traders, because that was predominantly my style back then, as it was a reflection of the majority of the type of spreads that I used to swing trade. Let's dissect what has happened with this calendar spread and why is it profitable. The first takeaway is that the SPX is still within the tent. So this right here is our tent of the calendar spread at expiration, and as mentioned in the video before, this is our T+0 line, which is the current P&L. So this right here, if we just look over to the left, is exactly where the profit is, or we can just take a look down here and that's what this is telling us. These slices right here are just to give us an estimation of what the theoretical P&L would be. In this case here, 1%. If the market went up 1%, the position will barely be up, as this is just about the break even on the T+0 line. If the market was to pull back 1%, the position will be theoretically up over $700, as we're coming back closer to the peak of the tent. The next thing to take notice is that during the duration of the trade, the T+0 line can be wider than the tent, and that's this magenta pinkish level that we see right here. These are the break evens on the T+0 line. This one to this one is our range for profitability. So the SPX is currently right here, whereas the tent at expiration is from here to here. It's a little bit more of a narrow range. This strategy, called a calendar spread, benefits from the passage of time or an increase in volatility for your long expiration. In this case here, December 27th, and this is what was addressed in part 1 of this video. So even if a trader does nothing, all we need is for price to continue to fluctuate throughout this tent or this range right here, and the position will continue to make profit every single day as long as implied volatility does not decrease at a faster rate than the time decay of your front month. If that sounds a little confusing, I highly recommend you check out part 1 of this video or any of the previous Counting the Spreads videos in which I have done over the past few years. As time continues to pass, this is December 6th, let's jump to December 9th. We can see that the profit should in theory increase. Let's just jump to Wednesday of next week. Profit should continue to increase as long as the SPX is at any of these ranges. As I showcased in the previous video, no one knows what's going to happen with the volatility, so we can try to speculate and adjust for volatility, but for the most part, these systems or these risk profiles try to do the best they can with an estimation of what your profit and loss should be. Now let's take a look at the implied volatility and what has happened since I've opened the trade. So this is going to be for the front month, and this is our back month. So right now it's saying, according to Thinkorswim, the volatility for the front month is now 11.89. When I first opened the trade, it was about 13.95, and the back month was 13.5. So now the back month, which is December 27th, is 11.84. You guys can see that these levels have now become closer to each other, whereas before this had about a 0.45% increase over this one. So now one can say the implied volatility has in a sense flattened out between these two, and that was the volatility skew that I addressed in the first video. There's no longer that much of a volatility skew between these two expirations. So if I was looking to open up a calendar spread, I would not choose these same expirations as the edge is no longer present. The flattening of the volatility skew between these two is what was the edge, and that's what this position has benefited from, as we can see in a reflection of the P&L. Now earlier today, so just under 2 hours, I took note of when the position was over 15%. This is what the implied volatility was. It was about a 1.82% reduction in implied volatility for the front month. Since when I opened the trade, it was 13.95. Earlier today, it was 12.13. That's about a decrease of 1.82. And look at our back month. It went from 13.5 to 12.8. That is a reduction of 1.42. The front month reduced in implied volatility much faster than the back month, and that is a bonus for calendar spreads. The market went from 6,044 when I first opened it to about 6,087 when I took note of this earlier in the day. Again, you'll see the P&L will fluctuate as the market is open, and now will be an excellent time to actually close out the trade, as plus 15% is generally going to be a great profit target for an income-based trader. I have seen these hits plus 25% before, and even all the way up to plus 50%, but that would require holding for another week or even another 11 more days. You would have to hold it into the week of expiration. I would never encourage a trader to hold these all the way until the day of expiration. The point is to get in them, get out when you hit these types of numbers, so 8%, 15%. If you're at 25%, you've definitely been holding it for too long. Again, for an income-based trader, if you're speculating or you're using your own discretion, you're essentially deviating from the plan from an income spreads trader's perspective. So what has happened since I've opened the trade is that the SPX has stayed within the tens, and the short strike has lost in value faster than the long strike. So as the market was being choppy for a couple days and then it gapped up and then it was just moving with low volatility up, that's created the opportunity for the short strike, which is this one right here, to lose in value. So this strike was sold for $71 in this case when I first opened it, and now it's going for $88. So even though it is now in the money and the market has gone up, it is losing extrinsic value. It has gained some intrinsic value because it is now in the money, but the long strike has also gained in intrinsic value, but it has lost in extrinsic value at a lower rate than the other one. So this contract here was purchased for $80, but it's now going for $97, almost $98. So it has gained $18 in premium, while this one has gained the same amount of intrinsic value, but it is losing its extrinsic value at a faster rate than the other one. And that is a large contribution to how calendar spreads make money. Lastly, let's just show you guys the example that I took note of. This was the alternative calendar in which I used the Monday to Monday expiration instead of the Friday to Friday expiration. This calendar spread actually outperformed the other one as it was up over 20% earlier here today. You guys can take note of the changes between the implied volatility. albeit I did journal this trade a little bit after the other one. So this one was opened about 15 minutes or so after the first calendar spread. So obviously it's not exactly a direct comparison, but I did have a feeling based on experience earlier in the week that this calendar would have performed better. It's just I had already opened up this one, and it wasn't until after I opened this one I was like, oh crap, this probably would have been a better calendar. I didn't want to close out the other one and then switch over to this one. I could have also then gotten this one, but you guys know I was in some calendar spreads. I was in butterfly spreads, and I also focused on the NASDAQ earlier this week, as I covered in a couple other videos. There's actually another video I have coming out on a follow-up to this one, if it isn't out already. And then to conclude, I just want to show you guys why these calendars are generally crap. So this is a calendar spread where I went with the next week Friday to the Monday expiration. And even though I've been trading these types of calendars for I think almost 4.5 years now or so, they can be wildly inconsistent. In my experience, if you're looking for consistency and you're looking for income spreads trading, you're better off going out at least 3 weeks. This 11 to 14 DTE is generally not going to cut it in comparison to something like this with a wider term structure. So it's a 7-day separation between your long and short strikes. If we go here, this is just a Friday expiration to a Monday expiration. So it's narrow, it's tight, it's cheaper. This is a double calendar spread, but look at this. Price has stayed within the range, and this crap has barely made any money all week. And even if the market pulled back right now, it's still barely going to be up anything. I'm in the same 4 lots of these here, so I'm using only $2,000 in capital, just under $3,000 in margin actually, and this trade has virtually done nothing all week long. And now I'm forced to make a decision: do I just close this or do I hold it into next week? And that's where you start entering a dangerous territory, because this looks very appealing, but then what's going to happen over the weekend is Friday's expiration is going to jump, and that's going to hurt this spread. So I think you can actually make this adjustment here. So yeah, so this is going to actually jump up, and then the same thing is going to happen. This might increase just a little bit, and there is room for it to be profitable, but you don't want to hold these into the same week. You leave yourself susceptible to all sorts of wild things that can happen. So I seldom run these types of trades. In my experience, it would have been better to just go with an iron condor or something like that. They can work. Obviously, when they do work, they are amazing for how low cost they can be relative to the range, relative to the type of profit you can make. All this is very appealing, but this sucks holding a trade for 4 or 5 days and you still see that your P&L is red. And that's largely also due to the fact that the time decay is not as severe. With these expirations being so close to each other, they're both affected by implied volatility almost at the same rate. So when implied volatility decreased for next week Friday's expiration, the Monday expiration after also decreased essentially at the same rate, if not faster. So even though I opened the trade when there was the same volatility skew, as we can see right here and right here, is about a 0.50% or so difference in implied volatility. Now that the skew has flattened out, it doesn't really matter that much, because our long strike has not held that enough gains to offset the difference here. This trade might have performed better maybe if I went with this type of expiration, but that's where being able to journal and going in and seeing how would that have performed. This is why I love option strat, because then I can go and choose a different expiration right here and then see how maybe that would have performed. We can see the historical price for this. I can jump back to earlier this week and see if I open it, if it would have performed better. And it looks like it would have, but only by about 20 or 30 cents or so. So still rendering it maybe not worth it. Again, the only way you'll get great at this for yourself, guys, is not just by watching a YouTube video. As detailed as I try to make these, you have to practice yourself. You have to take your own notes. You have to journal your own trades, especially if you want to have some sort of confidence, as well as understanding what's going on. Why did one calendar perform better than the other? Why did I make X amount of money in one versus the other? Or why is one not making any money or losing money when another one is making money? Why does one cost more than the other? All these types of answers you can figure out for yourself, as I did, but I actually learned more by actually just taking notes and journaling these trades for months on end, and that compounded into years of information and knowledge. But yet still to this day, they can still be nuanced and variations between which calendar can perform better. We're talking about a difference of maybe 2 to 3%, but if you're running these with 10K, which is usually what I would have liked to run them at, that's the difference of a couple $100 extra, which could end up being a difference between an extra $500-600 a month, which is the difference between an extra 5 to 7K at the end of the year, as it all compounds. Guys, if you enjoyed this video, let me know in the comments down below. Leave a like on the video, Subscribe to the YouTube channel if you are new here, and if you like or you are enjoying these follow-up type of videos to a specific trade in which I share on this YouTube channel, let me know, and I'll also try to make more videos like this next year. The feedback is always appreciated. Thanks for watching. I'll catch you in the next one.